Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving the AFM pre-September 2023 mock. So this video consists of question number 1, which is called Cygnus Company, and in the following videos, the second video will have the section B question number 1 and the third video will have section B question number 2. So this is the chronology of the videos. Let's get started with the first question. So I have the scenario. The name of the company is Cygnus Company, and the requirements, as always, contain total of 50 marks. So these are all my requirements. Just for my ease, I'm going to copy all of these requirements and bring them to my word processor so that I do not have to open this exhibit once again. So copying all the requirements. And I take them to my word processor. Now I can have all of these in one place and I do not have to open my the exhibit regarding the requirements once again. So just formatting them so that we have a clarity. This is the second part, this is the third part, and then we have our professional marks. So this is a big question, 50 marker, and let's get started. So the first requirement that I can see is explain possible strategies that the company could adopt to avoid a block on dividend remittances. Now this is relatively something that gets frequently tested in AFM exam, and nothing surprising over here. Discuss the role of WTO and possible benefits and drawbacks to Asgard of reducing the protectionist measures. Now, again, this is also something that is very often tested in the AFM exam. Now, let's have a look at what they want in the report. Prepare an evaluative report for the Board of Directors of Cygnus Company, which addresses the following parts and recommends an appropriate course of action. So, not only do we have to address the following parts, but we also have to recommend, right? So there are two requirements over here. So first of all, answer all of these and then also give a recommendation. So the first part is estimate of the value of the project before considering Galaxy's offer, then after taking into account some offer that we have gotten, and then a discussion of the assumptions. Now assumptions also get very often tested in the AFM exam, so make sure that you are preparing these questions well. So again, as we know, the professional marks in question number 1 of our exam are 10 marks. So let's get started. Let's read the first exhibit. It is an introduction to the nation of Asgard. Yeah, so the nation of Asgard has implemented protectionist policies since gaining its independence just over 20 years ago, making it challenging for global corporations to conduct business there. The World Trade Organization WTO and Asgard have recently held discussions, and now it appears likely that Asgard will drastically scale back its restrictive measures. So I can see that this pertains to my second requirement over here. So, encouraged by these discussions, Cygnus Company, a company producing packaged foods, is considering a project to set up a manufacturing base in Asgard to sell its goods there and in other regional countries nearby. An initial investigation costing $100,000 established that Asgard had appropriate manufacturing facilities, adequate transport links, and a reasonably skilled but cheap workforce. The investigation concluded that if the protectionist measures were reduced, then the demand potential for Cygnus Company's products looked promising. It also felt that an early entry into Asgard would give Cygnus Company an advantage over its competitors for a period of 5 years, after which the current project will cease due to the development of new advanced manufacturing processes. So this is the brief introduction that we have to the nation as well as the company. So I did not happen to see anything regarding to the dividend remittances. So let's see if exhibit 2 has any information about that. Asgard's currency, the peso, is currently trading at this much per dollar. Setting up manufacturing base will require initial investment, all right. Machinery, no sale, all right. Will require working capital, will be released back, all right. So this has some of the investment details. These will be handy when we have to perform our calculations. Production of the packaged foods will take place in batches of product mixes. These batches will then be sold to supermarket chains, wholesalers. All right. So nothing up regarding the dividend remittances so far. Yeah. So the current annual corporation tax is okay. Both countries are payable in the year that the tax liability arises. Bilateral treaty exists, and which permits offset of overseas tax against any liabilities in the country in which it earns the money. So projected operations we have read, and then I have the option to sell. Again, I do not see anything with regards to dividend remittances. So I can see that this is something that I have to frame on my own. So I can just mention over here, I can change the heading so just so that it becomes bolder. Answer to part A. So with this, now I can start writing my answer. This is a 4 marker requirement. So 2 well explained strategies would be enough over here. So let's write the answer. What are the possible strategies that we have learned? So first of all, they can use transfer pricing. So let's start the answer first of all by saying that Cygnus company would use, or you can say could use, a number of possible strategies to avoid a block on dividend remittances. Now with this we have provided the opening line. I'm just showing this as an example. I will not be doing the same for the other parts. So first of all, they can be using transfer pricing. So in transfer pricing, they can, for charge the subsidiary increase transfer pricing for the components that they are using, and this will increase the profit earned by Cygnus company, and this will decrease the subsidiary's profit. So this is how some money can be transferred from the subsidiary to the owner, which is Cygnus company. Then another method that we have can be a royalty. So royalty is nothing but some payment that Cygnus company can charge on its subsidiary, and this will also have transfer the profits from the subsidiary to Cygnus company, and this will not be shown as dividends in the books of accounts. Now another thing that they can do is that they can have a parallel loan arrangement. Parallel loan arrangement. So what happens in this? Cygnus company subsidiary can make a loan to the Asgard subsidiary of another parent company, which in return would lend an equivalent amount to Cygnus company. Now, what will be achieved over here? The same objective, and this can also be achieved with a currency swap, although there will be a risk of counterparty. The counterparty risk will exist in both these cases if you go for a currency swap. So these are a few options that you can put over here in your answer to part A. So currency swap arrangements can also be done over here. Now let's move on to the requirement B. Requirement B says discuss the role of the World Trade Organization and the possible benefits and drawbacks of Asgard of reducing these protectionist measures. Now, first of all, you have to see that the requirement has 3 parts. It has 3 small parts. So I can write my answer as answer to part B, and now I can move on to my answer. First of all, let's analyze what the requirement, let's break down the requirement. First of all, I need to talk about the role of WTO, then possible benefits and drawbacks. So then I have to tell about possible benefits. Benefits to whom? Benefits to Asgard. And then I have to talk about the possible drawbacks. Possible drawbacks to Asgard again. So this requirement is basically divided into 3 sub requirements. So since these carry 6 marks, I can either divide them equally. So this can be 2 marks for role of WTO, 2 marks for benefits, and 2 marks for drawbacks. So regarding WTO, what you can say is that you can tell that the WTO was set up to continue the General Agreement on Trades and Tariffs, which was GATT, and the main objective that it has, the main objective of WTO is to reduce the barriers on international trade. Reduce barriers on international trade. So this is the main objective of WTO. It is important to mention this. It does this by seeking to prevent protectionist measures such as tariffs, quotas, other import restrictions. It also acts as a forum for negotiation. So you can mention about restrictions on quotas, tariffs, and other such duties. And then it is also a forum for negotiation if two countries are trading internationally. So if they have any disputes and uh, anything that they are not liking about how they are trading with each other, so then they can go for negotiation and dispute settlement to the WTO. So this is enough information for your 2 marks for writing about the role of WTO. So dispute settlement, right? So this is the role of WTO. I can also bold this so that my examiner knows that now I have started with the possible benefits to Asgard. So now if Asgard has reduced the restrictions, what benefits will it have? The benefits that it will have is that first of all, this will make other nations reduce their protectionist measures against it. So it will have favorable relations, you can say trade relations with other countries also, with other nations. What other benefits can it get? Now it can also benefit from increased trade and economic growth. So if the terms are favorable, the trade will increase and so will your economy grow. So economic growth. So this can be another benefit that they can have. Now another advantage can be a competitive advantage in certain products and services, and they will be able to compete globally. So competitive edge in specific products and services, as well as having a competitive first of all, you have a competitive edge, and then you can also compete more effectively on a global scale. So on a global scale. So this is how, these are some of the possible benefits that Asgard as a country will get now that they are thinking of reducing the restrictions. Now what are the drawbacks that they could have? The drawbacks can be you can first of all, this they some industries might need protection. Some industries might need protection. So why is that? Now that you are opening your economy to international producers, then the domestic producers who may or may not have the technology that the other other nation producers are using, maybe they will lack in that aspect. So this could be one of the drawbacks of reducing the policies. Another thing that can be there is that if you are not putting these policies in place, countries of other countries may dump their products into your country. Now what is dumping? When the another country sells the products that it has probably stopped selling in its own country to your country at very cheap prices. So this is how dumping can also cause harm to your domestic economy. Why? Because the products that they will sell at very cheap prices, maybe your local producers will not be able to compete with those prices, and that can lead to losses for your economy. So this is how dumping can hamper the economy of the country of Asgard. Now, let's move on to part C. This is the last part in the 50 marker requirement, relatively a big portion to solve. So let's put our heading as answer to part C. So this part involves making a report. So we'll follow the same format that is suggested by the AFM examiner. So this starts with report to the board of directors of Cygnus company. So I will just say report to the board of directors, BOD, comma, Cygnus company. So then we start with an introduction, and then we will talk about all of these things that have been asked from them. So the requirements will become my headings over here. Please understand that it is very important to put the relevant headings so that it also becomes easier for the examiner to understand that you have also followed the professional format, as well as uh, you know uh, attempted all parts of the requirements. So this is the estimate of the value. Then the second requirement that we have is the estimate after considering Galaxy's offer. So I'm doing nothing, just copy pasting the requirements and putting them as headers. So this is the second heading. Then I can say assumptions can be my last heading, and then at the end, remember that I have to put a recommendation. So my recommendation and conclusion can be my last paragraph. Recommendation and conclusion. So these are my paragraphs in the report. I can also bold all of these so that the examiner gets to know that these have been differentiated and these are my headers. So the introduction will also be about the requirements only. So I can simply say that this report estimates the value of the project before and after considering the after considering Galaxy company's offer. This report, a recommendation has also been made at the end of the report, while also discussing the assumptions made in arriving at the calculations. Right, so this is my brief introduction, and then I can move on to estimating the value. So this will require us to go in the workings. So let's move on. So also I can see that they want discussion of assumptions and additional business risks which Cygnus company should consider. So I can also add this to my introduction. This report also includes additional business risks which Cygnus company should consider before taking the decision. Right, so with this, now my introduction is complete, and with assumptions I will also add the paragraph of additional business risks. So this is done. Right, so now let's move on to our calculations aspect. So regarding closing of the report, we have report compiled by, we just have to leave it like this, nothing to be written over here, report compiled by, and then date. These two you can leave completely blank because this is how the examiner wants them to be. Now let's come at the working notes, all the performing calculations. So I have my spreadsheet open now. Right, so I will just put in the basic format of my NPV calculation. So I can label this as appendix 1. So this is appendix 1, and this has the workings of estimated value of the Asgard project excluding the offer of Galaxy, excluding Galaxy's offer. So now I can move on to my calculations. First of all, I am showing my calculation of NPV, calculation of NPV, and I can put in my years and particulars now. So I can also mention that my so I have my investment details since everything is mostly in millions, so I can also mention over here that all the calculations that I am performing is in millions. And since I read the question before and I found out that the this involves multiple currencies, so it is better that we specify the currency also that we are making our calculations in. So let's write the years over here, then we have our, let's specify our currency as well, and then let's write the sequence of the years. So this is year 0, my apologies, year 0, 1, 2, 3, 4 and 5. So I have put my years now. First of all, let's see what the details are now. We have a basic format ready now. So we have the current exchange rate given to us. Initial investment also is given to us. Then tax allowable depreciation, all right. Lands and buildings, all right. So they require working capital. Okay, we'll come back to this exhibit later. Let's look at our projected operations. So we have information given for 5 years to us. Let me adjust the size so that we are able to see both of our exhibits. Right, so the production of the packaged food will take place in batches. These will be sold to supermarket chains. All right, the sales will be in AP. These will be estimated. All right, so we have the sales given to us, batches produced and sold. The current selling price for each batch is estimated to be 115 200. So if I am performing my calculations in millions, first of all, let's go to working notes. So I'm leaving a good amount of space for my calculations, and then I go to my working notes. I will shift my working notes down below if the need be. So working notes. So let's say that the first working is about the sales. So for sales, I have my years starting from here. So 0, 1, 2, 3, 4, 5. Right. So with regards to sale, we have the batches sold, produced and sold given to us. So these are 10,000. Then I have 15,000. Then I have 30,000. Then 26,000. And then I have 15,000. So let's see, the selling price is given to us as 115,200. So let's put that as well. So selling price, this is 115,200. Then I have the costs related to them are currently estimated. Okay, we'll need special packaging. Currently the cost of special packaging, okay. Training and development costs, all right. Then I have the cost relating to production and sale of each batch will increase annually by 10%, but the selling price and special packaging costs will only increase by 5% every year. So if this is my selling price in the first year, so my selling price is also going to increase in the next coming years. So I can just find out my revenue over here. So my revenue will be this multiplied by this, and with this I have my revenue. Now I will also have to inflate this value. Why? Because there is an inflation that applies to it, and the inflation is 1.05 because 5% is the rate of inflation, and this I will raise to the power according to the years, so that we just have to drag this calculation. So this will be this much, and again okay, I can say this is my revenue, this is my inflated revenue, and with this I can say that this I can also calculate my revenue in millions. So in millions. I will just divide this by a million. Right, so this is my value that will come out in millions. Now again, similarly, I can do this for the rest of the years also. So my revenue in this year will also be, multiplied with the inflated amounts. So I can say that my revenue will be, if I just, right, so I can straight away find my inflated revenue also. I can multiply this value with my selling price, which is this, and multiply this by 1.05 raised to the power 2. Raised to the power 2 can be linked over here, and then I have my final answer. Again, I can copy this formula and get my amount in $1,000,000. Now again, I can do the similar thing. I can just fix the selling price that I have over here so that it will do the calculations by default for me. If I just drag this, right, so let me just copy the formula down below also. So we have our sales in millions of AP currency now. So I will just link these cells over here. This is D45 and this is about sales revenue. I can also say that this is working number 1 and the currency that we are using is AP over here. And then I will link these cells. So this is for year 1. I say this calculation has been performed over here and I will just link these. If I just copy this, the values will automatically appear over here. Now let's move on to the second thing that we'll take over here. The second thing that we take is our production cost, right? So production cost. Now again, let's create a working for the same. So let's go down again. This is working number 2. This is regarding production costs. So regarding the production costs, I have mentioned over here that the production costs of each batch is estimated to be 46,500 and the inflation that is applying on these production costs, this will be 10% annually. So my production costs for the first, I already have the years written over here, so I'm not going to mention them again and again. No need to do that. I already have my number of batches also, so I will just multiply this by the cost of production, which is given to us as 46,500, and then I will inflate it at 10%. So 1.1 raised to the power 1 because this is the first year, and with this I will have my amount. Now I just have to convert this to millions. First of all, let's drag this for all of the 5 years. Right, so these are the costs that we get for production in each year. Now let's convert these to millions. So this, I'm just dividing this by a million, just copy pasting the formula over here as well, and now I have my production costs with me. So I can just link these above. This is cell D50. I can refer this cell over here equals to D50 and I will get my value over here. Right, so I can just copy this and paste this over here and my figures will automatically appear. Now the next thing that I have to calculate over here is my special packaging. So special packaging, and we will create a working number 3 for this. So let's go down again. I have my working 3 now, and this is about special packaging. So with regards to special packaging, it is mentioned that the cost of the special packaging material is 200 per batch, and the special packaging costs will increase by 5% every year. So 200 multiplied by per batch, I have my number of batches over here, and then I will multiply this by 1.05, raising it to the power of 1, because 5% is the inflation rate that is applicable to this. So I will just copy this formula for all the years also, and with this I have my cost of special packaging. So if I just divide that by millions, but again see that this packaging cost is in dollars and our entire calculation so far has been in AP, right? So this is something that we will have to convert now. So let's work out the exchange rates first. We will have to convert this using the exchange rates that are given to us. I remember seeing the exchange rate over here. So this is 75 right now. And any information about the future exchange rates? Right, so we do have the current rate of inflation in the home as well as the foreign country. So we have the information that we need to calculate the exchange rates. So if I just adjust the size of this, yeah, let's have a working over down below for the exchange rates also. So I have W4 and this is exchange rates. So in the year 0 my exchange rate is 75, and then in the coming years what I'm going to do is I'm going to apply the inflation to find out the exchange rates. So I can see that in my I will use the formula of the purchase power parity theory. So this is do we have the formula given? I could just show that to you. Yes, we do. So for purchasing power parity, I will multiply the spot rate by 1 plus, the inflation in the counter country and then in the base country. So the counter country that we have is the nation of Asgard, which is 8%. So 1 plus 8%. And then I will divide this by 1 plus 4% with 1 plus 2%, which is the inflation in the base country. So with this I have worked out my exchange rate for the first year. Similarly, if I copy this formula for the rest of the years, I will have my answer for the remaining years also. So these are the exchange rates that I have worked out. So I will also mention that I have calculated using the purchasing power parity. Right. So now I can convert these costs. So this is 210 and this is in dollars. So now I will, convert this to AP. And how will I do that? I will use the exchange rate of the second year to find this out in AP. So apologies, this will have to be multiplied because in AP this will be more money. Dollars is expensive and AP is relatively cheaper, so this is going to be more money. And then I have my answer for all of these years. Now I will move ahead and calculate this in millions. So this is in dollars and this is in millions that I'm converting. Sorry, this is in AP. Right, and I can put a bracket over here and say that this is dollars. So I will just find this out in millions. I will just divide this by a million. 1,000,000,000, right? So just dragging this formula, I will have my special packaging costs with me, all converted in AP. So I can just link these over here and this will be right, and I can drag this to the remaining cells also. So with this I have found out my special packaging costs also. Let's move on to the further costs now. Now let's talk about depreciation. I will close this and go back to my the exhibit that had information about investments. So it is saying that we require an initial investment of 2500 million AP, and to cover the cost of land and buildings 500 and machinery this much. Tax allowable depreciation is available on machinery on a straight line basis. So my machinery is 2000 million AP and tax allowable depreciation is available on a straight line basis. That means 5 years. So 200 million divided by 5 years, I will have my depreciation. So this is 200 divided by 5. Sorry, that was 2000 million, right? Yes, this was 2000 million. So I forgot to put 10. So this is going to be my depreciation. I can just adjust the size so that we are able to see both of these together. So I will just copy paste this to the remaining part also. So this is going to be my depreciation. This is again in AP. Now moving on to the last cost that we have before we find out our profit, which is the training and development cost, which I read in the third exhibit, which talks about the projected operations. So we know that the training and development costs related to the production of batches are estimated to be 80% of production and selling costs, excluding the cost of packaging in the first year. So that means in the first year, let me say that the currency for this is also AP and for this also is AP. We have converted everything to AP so far. And then let's talk about the training and development. So this is going to be 80% of the production and selling costs. So production cost is nothing but 511, and with regards to selling, it is saying that it wants me to exclude the special packaging. So I can say that this is going to be 80% of this amount, which is the production cost. So this comes out to be 409.2. And in the second year, how much is this cost? In the second year, this will be 20% of these costs. So I can say 20% of these costs, which is the production cost. So now I have my cost for the second year also, and then nil for the remaining years. So this will not have any impact in the further years, only year 1 and 2 that we are incurring the training and development costs. Now solving this, I will have my profit before tax. So my profit before tax is going to be sales revenue minus production costs minus special packaging minus depreciation and minus my training costs. So I have my answer as a negative 277 over here. I will just paste the formula to the remaining years as well. So with this, I have my profit before tax. Now moving on to the tax, let's see how much is the tax rate. I think information, yeah. So the current annual corporation tax rate in Asgard is 25%. So I will put tax according to 25%, tax at 25%, right? So I will just say that both countries are payable, okay, in the same year. Bilateral treaties agree, so okay. And also any tax liabilities Cygnus company incurs on overseas earnings, so we do have the permission to offset that as well. So in the first year, my tax is going to be minus 25% of this profit before tax. I forgot the percentage sign, right? So that means I do not have to pay any tax in this year. So this is going to be my expense. Then just finding out for the rest of the years also. So these are going to be my tax payments. So now I have my profit after tax. So my profit after tax becomes this minus the tax that I am paying. So I can just uh, copy paste the formula to the remaining cells also. With this, I have my profit after tax. Now I will add back the depreciation. Add back depreciation. So I will just put these cells over here. So 400 will be added in each year, right? Then what do we do after adding the depreciation? Let's see how much was our capital investment. So capital investment. So it was mentioned that we will have to invest 2500. Let's see. Yeah, so 2500 million was my initial investment. This will be done at year 0, so minus 2500. Now anything else that we are forgetting over here? We also have that the market value of the land and buildings will be 1100. So that means this will be something that we will be getting at the end of this project. So let's write over here sale of land, and this will be in the last year at 1100. So now moving on, what do we have? Last thing that we have to adjust for is the working capital. Will require 250 million for working capital immediately. It is not expected that any further injections of working capital will be required for 5 years. So the working capital calculations is very easy in this question. So I can simply say that this is a minus 250 right at the beginning, and with this I have finished with my calculations. In the last year I'm going to get this money back, so I can link it to this cell also, and I'm going to get the same money back at the end of my project. Now let's also write the currencies. It's all AP over here, right? So now we have our the cash flows that we have, total cash flows, and again the currency is AP. So now I will simply use the formula over here. I am taking my profit before tax. So rather we can take it from profit after tax and put the sum function. So the sum of all of this will give me my answer. Right. So we do have our the final answers. This should rather start from above. It should start from your profit before tax. This is where we left our calculations, so it should begin from here, and with this we have our final total cash flows, right? This again seems to be too much. Wait a second. 2750. Yes, it has to start from here. Right. Now we have the total cash flows before us, and we have to find our answer in dollars. So let's just work back to dollars again. So I can say that the cash flows, total cash flows, and let's take it to dollars this time. So how will I convert this to dollars? I will simply divide this by my exchange rate. So I had my exchange rates over here, and with this I will have my values in dollars. I can simply copy paste this to the rest of the working also, and now I have all my answers in dollars. So now what is the discount rate that we are supposed to be using over here? Let's find that out. Okay, nowhere does it talk about the cost of capital. Yeah, okay. So the risk adjusted cost of capital applicable to the project on dollar based cash flows is 12%. So now we have our cash flows in dollars. So I'm now just going to put the discount rate. Discount rate is at 12%. So I can simply use the formula of NPV over here. NPV equals okay, let's find this out here, equals NPV comma, I'm putting the discount rate, selecting all cash flows from year 1 to 5. Do I have them all? Yes. And then I will add the first 0 year outflows. So with this I do have a negative NPV over here. I can format it as currency, and this will say that this goes on to show if I convert this into Now this is in millions, right? So I can say that this is the NPV in millions. If I convert this to normal figures, absolute figures, I will have my answer as just going to multiply this value with a million. So that means I have a negative 901,000. So let's format this to currency also. So now this is my absolute NPV. So the project without let's comment over here in our word processor that the project does not have a positive NPV, right? So the project has a negative NPV of how much was the amount? Let's copy that. So 901. Let's roughly round that off to 902,000. So of $902,000. This based on this, the project should be rejected. Now let's link that refer appendix 1 over here, because that is where we have shown all the calculations. So this is how you draft your answer in the report format. Now moving on to the estimate of the value of the project, taking into account the offer of the Galaxy company. So now let's see Galaxy company's offer. We have read it till here. Inflation rates will not change, remitted back to Cygnus. Finance director is of the opinion that there are many uncertainties surrounding the project and has assessed that the cash flows can vary by a standard deviation of as much as 35%. So we have a standard deviation 35%. Recently, they have the option to sell for 35 million at the start of year 3. Cygnus company will make the decision of whether or not to sell the project at the end of year 2. So we do have the BSOP calculator also given to us over here. This is our BSOP calculator. Now let's find out what are the values we are going to be putting over here. So first of all, we have the standard deviation given to us as 35%. So I'm entering that. As much as information we have, we'll keep entering that. And the decision of whether we are not selling or not the project, this will be taken at the end of year 2. That means my time is 2. So let's also have a look at the risk-free rate that we are going to be using over here. And it is mentioned that the risk-free rate which is considered on the treasury bills is 4%. So I'm going to put this also as 4%. Now what else do I already have given to me? I also have my exercise price, which is the price at which I can sell. This is $35 million. So I can enter this as well over here, 35, 1, 2, 3, 1, 2, 3. So with this, I have my exercise price also. It is not possible to expand this. So actually this seems to be locked. So I'm not able to expand this. All right. Then we can, now what we have to do is we have to find out the PA, which is the present value of our underlying asset. So how do we find that out? Let's go to our spreadsheet. So for this, we will have to find out if we are going to sell the project at the end of year 2, that means we are not going to be getting year 3, 4 and 5 cash flows. So that means we will have to discount these specific cash flows. So I can say that this is appendix 2 and this is estimated value with Galaxy's offer. Right, so I can find out the value of these cash flows. I do have my cash flows given to me. So for year 3, 4 and 5 I need them. Yeah, so these are my cash flows for 3. My apologies. This is for year 3. This is for year 4 and 5. So I have my cash flows over here with me, and now I will just have to discount them. So cash flows foregone and then discount factor. Discount factor has to be used for 12%. So 1 by 1.12, or you can alternatively use the table also, and this has to be raised by power of 3. I can just link it so that we have it for the rest of the years also. And for the third year, I have my discount factor, and then I will just copy paste this to the remaining ones also. Right, so these are the discount factors that I have for these 3 years that I will have to forego my cash flows for. And then if I just multiply this to find the present value, so this will be the product of these two. I can copy this to the remaining cells as well. So now I have the present values of all 3 years that I'm going to have to forego. And if I just total these up, I will have my total that I have to forego. So this will be the sum till here, right? So this comes out to be roughly 28.29481. So I can just convert this into the absolute figure because this is in millions, right? So this is my final answer. I can just copy this and paste this to my BSOP calculator, right? So now I have all of my answers given to me. I have my call option as well as the value of my put option. So which of these will we have to consider over here? Uh, we are having the option to sell this project to Galaxy company. So what offer are we going to consider over here? We are going to consider the put option because we have the option to sell this project to this company. So how much will be the NPV if we are going to sell it? Let's copy this amount. This is 8137056. This is 8137056. So, and if I have my NPV with me, so that means I am subtracting the NPV with the put value option. So what is the option, what is the answer that I'm going to get? This minus this value, so I can just sum it up. So this is something that we'll no longer get, and this is the net present value with the put option. So I can convert this into the currency format also so that it looks neater. So we have roughly 7 million that we will be earning from this project if we have the if we consider the option to sell this project to Galaxy company. So I can just mention this in my word processor also. I can say that if we are considering their offer, the NPV of the project comes out to be dollar 7235,000 comes out to be an estimated dollar this much, and this is a positive NPV, and the project can be taken up since the NPV is positive, and the project can be taken up since the NPV is positive. Now we do have finished with the second requirement also, and now we can move on to the assumptions that we have taken in this calculation. So let's move on to the writing the assumptions. Recommendation we'll put at the end, right? So as for the assumptions, we have first of all, we have assumed that the figures relating to the variables such as revenue, cost, taxation, initial investments, their recovery, inflation figures, and cost of capital are accurate. So we have assumptions about revenues, inflation, costs, cost of capital, and we have assumed that these are all accurate, right? There is also a possibility that they may be not what we have assumed them to be. So we have also taken the assumptions with respect to exchange rates. Exchange rates have been predicted using the purchasing power parity theory. Right. And then another assumption that we have taken over here is that Cygnus company will be given and will fully utilize the benefit of the tax treaty where it is based. So tax treaty is another assumption that you can write. And then it is assumed that the short dated dollar treasury bills are equivalent to the risk free rate that we need for the BSOP model. So under BSOP we have assumptions about the risk free rate being the dollar treasury bills. So that is also something we have assumed. Another assumption that we have made is that we have simply taken the finance director's figure of 35% standard deviation. Finance director 35% standard deviation. Another thing that we have assumed over here is that we have the offer of Galaxy company will fulfill its offer to buy the project in 2 years, and there is no uncertainty regarding this. And the uncertainty with respect to Galaxy company buying in 2 years. So maybe what will happen if they do not buy the project, right? So we do also have to consider that situation. So we can recommend that this company, Cygnus company, can also consider signing a contract, because otherwise if we do not consider the offer of Galaxy company, we are getting a negative NPV, right? So if we want to take this project, we'll only take this because we have the offer from Galaxy company. So we want to make that sure that they will buy this project from us after 2 years. So they may consider a legal contract also. Now we have a lot of assumptions in the BSOP model as well. BSOP model assumes perfect markets, interest rates, and the distribution of the asset prices. It also assumes that the underlying assets can be traded, but here we do not have such options, right? So BSOP assumptions can also be mentioned over here. So this talks about the saleability of the underlying asset in the market. And what are the other assumptions that I just mentioned? Perfect markets, constant interest rates, etc. Constant interest rates, perfect markets. So these are few assumptions that you could mention over here. I can see that the requirement pertains to 12 marks. So you can equally divide this between the assumptions as well as business risks. So you have roughly 6 marks for your assumptions, and we have written how many? 1, 2, 3, 4, 5, 6, 7. So anywhere between 6 to 7 assumptions will fetch you the required marks. Now let's look at the additional business risks. So what are the additional business risks that will be faced if we take this project? So we have to consider a few other points also. Investing in Asgard may have political risks. So first of all, we have to talk about the political risks. Do not mention the numbers in your answers. Just use small paragraphs for writing your answers in the exam. I'm only writing this so that you have the basic pointers and then you can expand on those. So the current government may be unstable, and if there is a change in the government, the new government may impose restrictions such as limiting the amount of remittances which can be made to the parent company. So the Cygnus company will have to assess the likelihood of such restrictions and what are the ways in which they can evade such restrictions, right? So another thing that they have to consider is how will be the infrastructure in this country. Although they have checked out that they have reasonably skilled labor that is cheap, also they have infrastructure, but again it is important that they make sure that the physical infrastructure of the company is good and the food batches remain economically stable, right? So then in the next point that we can also talk about, you can say that they may have to ensure that it will be able to export the special packaging material into Asgard. Now we read that there will have to be a special packaging, right? So they will need to ensure that they are able to export this material, export special packaging material to the country of Asgard, right? So this is another thing that they should have to consider before taking this project. Now another thing that they can also consider is the likelihood of protectionist measures, right? So likelihood of protectionist measures. So this can also be elaborated when you are writing the third point itself. So let me put it back. So you can add this over here only. Another thing that you can say over here is that there may be new taxes in that country. So again, fiscal risks. So fiscal risks pertain to anything related to the government. So maybe new taxes, or maybe higher tax rates, or even the bilateral treaty can cease to exist. So that will also affect the company negatively. So this is something also that they should consider. Another thing that they can consider is their reputation. Now what about reputation? When they are going to another country, the risk of the loss of reputation through operational errors would also need to be assessed and also mitigating. So when they are setting up internal controls, segregation of duties will also be important. Now other things that they can also consider is quality control. Since they are moving to another country, maybe the production facilities are not so good, and they will have to ensure that the quality is maintained. So these are a few risks that you should write about when writing your answer. Then let's come to the last portion, which talks about the recommendation and conclusion. Now how can we conclude this report? So we can say that after considering the offer of Galaxy company, the board of directors can proceed with the project, as long as they can be assured that the offer will be definitely made. Now there is considerable uncertainty regarding the accuracy of these, and in addition to the assessments of value conducted in appendices 1 and 2, sensitivity analysis and scenario analysis are probably needed. So first of all, let's write about can go ahead, can go ahead since Galaxy company's offer results in a positive NPV. However, consider the reliability of the offer. Another thing to consider that we just spoke about is that they have to make sure that the scenario analysis and sensitivity analysis would enhance the understanding of the directors about this project. Now what else can we recommend? So if we are not considering the offer, then we have a marginal negative NPV, although the results of the sensitivity analysis need to be considered. So it is recommended, if only these results are taken into consideration, the board of directors should not proceed with the project. However, decision is marginal, and there may be other valid reasons for progressing with the project, such as possibilities of follow-on projects in Asgard. So let's talk about both the possibilities. So Galaxy's offer, without Galaxy's offer, our NPV, the NPV of the project is marginally negative, means it is negative with a very small amount. So even though it is negative, directors may still want to go ahead if they think there are there may be follow on opportunities. So if you are entering into Asgard once with this project, maybe you lose on some marginal amount of money in this project. Maybe by entering this company, you get more and more opportunities within this country, and that will help you to earn positive returns. So in that scenario also, if the directors feel that this may happen, they may still go ahead with this project even if the NPV is some amount of negative. So with this, we have come to an end to question number 1. This took quite a lot of time also, so I hope that this is clear to you. Please feel free to comment down below to ask any queries that you have. You can also message us on our Instagram page at BeingACCA. Thank you so much for watching. Please stay tuned for the next one.